Jeremiah and Aubrey were hired 11 days apart into identical roles, and their salaries differ by about $400 a year. Each has $96,500 sitting in savings. On paper, they are the same person twice. In March, Jeremiah buys a house, 3 bedrooms, a driveway that needs resealing, and a kitchen the listing agent called full of potential, which is real estate for the dishwasher is a rumor. Aubrey signs a 12-month lease 4 blocks away. Nearly the same house. Nobody throws a party for a lease. 5 years later, one of them is about $70,000 ahead. It is not the one with the house. And if you are currently doing this math on yourself, the reason should worry you. But that is not the shocking part. Change one single number in this comparison, one number that neither of them controls and nobody alive can predict, and Jeremiah wins by $700,000 instead. My name is Nick, and I have spent an embarrassing number of evenings building spreadsheets that ruin my own opinions. If anyone has ever told you that renting is throwing money away, hit subscribe and drop a like. Because today we are running this comparison honestly, in both directions, including the parts that make my own argument look bad. Let's start with the uncomfortable reality, which is that almost everyone argues this wrong. You compare a rent payment to a mortgage payment, you notice the mortgage builds equity, and you stop thinking. That comparison is garbage. It is like choosing between 2 cars by looking only at the paint. The only honest way to run this is to compare unrecoverable costs, money that leaves your life and never comes back. When you pay rent, all of it is unrecoverable. That is the argument against renting, and it is a real one. But when you own, you have unrecoverable costs too. Mortgage interest, property taxes, insurance, maintenance, closing costs going in, agent commissions going out. None of that becomes equity. It evaporates exactly the way rent does, it just evaporates through a nicer sounding pipe. So your actual question is not rent versus mortgage, it is whose money is disappearing faster and what the other person is doing with the difference. Everything else here is arithmetic on top of that one idea. Here is where you are as of this recording. The 30-year fixed sits at about 5.95%. The median existing home just sold for $482,500, an all-time record. And Realtor.com ran the numbers this past March. Owning a starter home, $3,120 a month. Renting something comparable, $2,150. Owning costs 55% more for the same roof over your head. And here's the part that stopped me. Renting is currently cheaper on a monthly basis in 49 out of the 50 largest metro areas in this country. Not most of them. 49 out of 50. How does that even happen? Record prices and rates that refuse to come down at the same time. That gap is not normal. Historically, the premium to own is small, and sometimes it does not exist at all. So should you just wait it out? Fannie Mae projects 5.8% through next year, the Mortgage Bankers Association 5.9%. Nobody is forecasting a 4 in front of that number. Waiting for 2021 to come back is not a plan, it is a hobby. So let's stop watching Jeremiah and put you in his shoes. You buy his house. $482,500 with a payment you can quote from memory and a cost you have never once calculated. You put 20% down. $96,500 gone from your savings into a wall. You borrow $386,000 at 5.95%, and your principal and interest payment is $2,303 a month. That is the number you tell people, that is the number on your pre-approval letter, that is the number you have emotionally accepted. Then reality shows up with an invoice. Property taxes at about 1% nationally add $402 a month, insurance another $275, maintenance, which Harvard pegs at 1 to 2% of value per year, adds $402 whether or not anything breaks. Bankrate found the average homeowner spends $21,400 a year on everything that is not the mortgage. So your real monthly cost is not $2,303, it is $3,382. You are off by $1,079 a month, which is roughly the entire amount you had budgeted for existing. And those side costs are the ones misbehaving. Insurance is up about 62% since 2021, 3 times inflation. In Florida, the average premium is projected at $9,700. Property taxes rose 12% nationally in 2 years, because when your home value goes up, the county notices immediately. Funny how that works in only one direction. Now, you are thinking, sure, but I am building equity with every payment, right? And this is where I have to show you the least popular chart in personal finance. Over 30 years, you will pay $443,000 in interest on a $386,000 loan. You pay 115% of the house's price to the bank on top of the house's price for the privilege of not paying it today. And it is front-loaded. In your first 10 years of payments, roughly 81% of every dollar goes to interest. After a decade of never missing a payment, you will have knocked about $57,000 off the balance. 10 years, $57,000 of progress. That is not a wealth-building machine. That is a very slow subscription service with a lawn. And no, the mortgage interest deduction does not save you. It is the most confidently cited benefit almost nobody actually receives. After the 2017 tax law nearly doubled the standard deduction, the share of filers who itemize collapsed from 31% to under 10%. You take the standard deduction like everyone else, which means your deduction is worth precisely nothing. It is a benefit that exists mainly at barbecues. So now let's be equally hard on Aubrey because her side has a catch that is honestly bigger than yours. Remember, she is 4 blocks from Jeremiah's front door. She rents the comparable house for $2,150 a month. She pays about $200 a year for renter's insurance and $0 for the water heater that dies in February. When her roof leaks, she makes a phone call, you make a decision. But renting only wins if Aubrey does the boring thing, and this is the entire ballgame. She has to take the $96,500 she did not spend, plus the closing costs she did not pay, plus the $1,079 monthly gap between her rent and your true cost, and put every bit of it into index funds, every month, forever, without touching it. Most renters do not do this, they spend the difference, and if Aubrey spends it, this whole video collapses and you win by a mile, because your mortgage forces you to save whether you feel like it or not. Amortization does not care about your mood. That is the strongest argument for buying that exists, and it has nothing to do with real estate. A mortgage is just a savings account that yells at you. So let's assume Aubrey is disciplined. 7% returns, 3% appreciation, 3% rent growth, 7% to sell. Hold on to those assumptions, because a woman named Nadine in Cleveland is going to break every one of them later. Year 3. Jeremiah's old house, now yours, is worth $527,000, which feels fantastic right up until you subtract the mortgage balance and the cost of selling. Your actual net position is about $121,000. Aubrey's portfolio is about $162,000. She is up $41,000 on you. Year 10. You have replaced a water heater, a roof, and most of your weekends. You are at $292,000. Aubrey sits at $345,000. The gap is $53,000. 7 more years of your life, and that gap moved $6,000. Which tells you something important. This is not a blowout. It is a tie game being decided by assumptions, and I am about to change one. But numbers on a screen are not what this decision actually feels like, so let me put it in the terms you will really experience it in. Being $1,079 off on your monthly cost does not look like a spreadsheet error. It looks like getting the HVAC quote on a Tuesday and quietly canceling the trip you promised your kid in March. It looks like a roof estimate for $11,000 and the words, "we will figure it out," said out loud to nobody. It looks like standing in your own driveway doing math about whether the water heater can survive one more winter. It looks like being one broken thing away from your emergency fund every month for 11 years. And Aubrey's version is not free either. Hers looks like a landlord who will not replace the dishwasher. It looks like painting a wall she does not own. It looks like an email in February with the subject line lease renewal and the 60 seconds before she opens it. It looks like being told, very politely, that her rent is going up $200 because the market says so, and there being no version of this where she gets to say no. Neither of them is comfortable, they are just uncomfortable in different currencies. But first, your phone rings. Year 6. A job offer in another state, $20,000 more a year. Aubrey gives 30 days notice, loses a deposit, and rents a truck. You have a different experience. Selling costs run 6 to 9% of your home's value once you count commissions, transfer taxes, and buyer concessions. And yes, that famous lawsuit settlement was supposed to fix commissions. 2/3 of agents saw no meaningful change. $418 million in settlement money bought the industry a brand new form to sign. So you owe roughly $38,500 just to walk out of a house you owned for 6 years, during which your loan balance moved $31,000. You did not lose money on the house, you lost it on the doors. So the single most important variable here is not rates, and it is not prices, it is time. Nationally, you need 5 to 7 years in a home before buying beats renting, purely because transaction costs are brutal on both ends. And here is the reassuring half, because I promised you both directions. The median American seller has now owned for 11 years. Today's buyers expect to stay 15. Most people who buy are not you in year 6. They are you in year 20, and you in year 20 is doing fine. So watch what happens when nobody moves. Run it out 30 years. Aubrey, the disciplined investor, ends with about $1.4 million. You end with about 1.3 million, she still wins, barely 30 years of mowing, and she is ahead by the price of a used sedan. Then year 31 arrives and your mortgage is gone. Aubrey's rent, after 3 decades of 3% increases, is about $5,800 a month, and it keeps climbing until she dies. Every spring, she opens an envelope that tells her what her home costs now. You stop getting that envelope. Your cost drops to taxes, insurance, and upkeep. About $2,250, you live for less than half of what she pays. In a house, nobody can ask you to leave. That is what people mean when they say a home is not an investment, it is a hedge. You did not out-earn Aubrey. You bought your way out of the rent market permanently, which matters enormously if you plan to retire on a fixed income, and most of us do. This is also why the net worth statistics look so lopsided. The Federal Reserve found the median homeowner had a net worth around $396,000 against $10,400 for the median renter, 38 times more. But everyone quotes that dishonestly. It is not proof that houses create wealth, it is largely selection bias, and that statistic is doing a lot of quiet work to avoid mentioning that rich people buy more houses. The house did some of it, mostly by forcing people to save. Okay, the number I promised you in the first 90 seconds. Here it is. Every projection I walked you through assumed home prices rise 3% a year. Change that to 5 and everything inverts. You pass Aubrey in year 5 and finish $700,000 ahead of her. Change it to 0 and she beats you by $650,000. 2 percentage points. That is the entire argument. And it is a number nobody on earth can forecast, including all the people who will confidently tell you they can. So what does history say? Robert Shiller built the longest home price dataset that exists, going back to 1890. After inflation, American home prices have appreciated about 0.5% per year, over a century and a third. That is not really an asset class, that is a savings account with a roof and a property tax bill. The counterpoint, and it is a good one, is that appreciation is not where housing's return comes from. The best long-run study, 16 countries over 145 years, found housing's total return runs about 7% real, competitive with stocks. But almost all of that is rent, the rent you collect or the rent you avoid paying, not the price going up. So when someone quotes you 7% while also promising appreciation, they are counting the same dollar twice and hoping you do not notice. Which brings me to the thing that actually decides this for you, and it has nothing to do with your discipline or your personality. It is your zip code. Take Nadine in Cleveland. She buys a house for $135,000. Her total monthly cost, everything included, is about $1,050. Renting the same house would run her $1,400. Nadine is cash flow positive from day 1, breaks even in year 3, and by year 10 she is roughly $104,000 ahead of where renting would have left her. Now move Nadine to San Jose. Same person, same job, same discipline. A comparable home costs $1.7 million. Owning runs about $12,800 a month, renting it runs $6,200. That gap, invested, puts her $400,000 ahead by year 5 and over $800,000 ahead by year 10. There is no version of that math where buying wins early. Nadine did not change. Her zip code did. So here is the number you need, and you can work it out tonight in 40 seconds. Take the price of the house you want. Divide it by 12 months of rent on something comparable. Under 15, buying is usually right for you. Over 25, renting and investing almost always wins. Cleveland runs around 10, San Jose runs over 30. Jeremiah sits at 18.7, which is exactly why his 10-year gap was 48,000 instead of 800,000. He is right on the fence line, the single worst place to stand. And if you have been running this math on yourself and quietly concluding you are bad at money, can I show you what you are actually up against? Since 2000, median household income is up about 92%. Median home prices are up 177. The median home now costs roughly 6 times median income. In the 90s, it was 3.2. If prices had simply tracked incomes, the house you are looking at would cost around $257,000 instead of nearly $500,000. The country is somewhere between 1 and 5 million housing units short. Starter homes under 1,400 square feet fell from about 35% of new construction in 1976 to around 10% today. Builders quietly stopped building the exact house you are trying to buy, and half of all outstanding mortgages carry a rate below 4%. Those people are never selling, and honestly, you would not either. The Federal Housing Finance Agency found this lock in effect pushed prices up 5.7% by itself. The market did not just get expensive, it got frozen, with everyone you need to buy from standing safely on the inside, which is why the median first-time buyer in America is now 41 years old, not 30. 41, an all-time record and the kind of record nobody holds a ceremony for. First-time buyers are 21% of the market, also a record, in the wrong direction. And nearly 43 million American households now spend more than 30% of their income on housing, the most ever recorded. So were Jeremiah and Aubrey ever choosing between two good options? No, they were choosing which flavor of a bad deal fit their life better, and so are you. Aubrey is not winning because she is clever. Jeremiah is not losing because he is reckless. All three of you are standing in a market that stopped making sense about 15 years before any of you had a down payment. You did not do this. This was done to you, slowly, by zoning boards and interest rate policy and 20 years of not building enough houses. By the way, I opened a school community where I break down how to build income streams that do not depend on any of this, including how to start and scale a faceless YouTube channel from zero. Link is below. Back to it. So here is the honest verdict, and it is not a verdict. Be Nadine if three things are true at once. You are staying at least 7 years with real confidence, not vibes. Your city's price-to-rent ratio is under 15. And your down payment is big enough that private mortgage insurance is not bleeding you every year until you hit 78% loan to value, which usually takes 7 or 8 years of paying a monthly fee for the crime of not already being rich. Be Aubrey if any one of those is false. Rent if there is a decent chance you move within 5 years. Rent if you are in San Jose, San Francisco, Seattle, Los Angeles, Austin, or Denver, where ratios sit above 25. And if you know honestly that you will never invest the difference, buy for exactly that reason. Know which of these two people you actually are. And notice this before you decide. 63% of recent buyers report at least one regret, with unexpected maintenance topping the list, yet 70% say they would do it again. Both are true at once. Owning a home is frequently the right financial decision and frequently a worse experience than anybody admits at the housewarming. So stop treating this as a character test. Renting is not immaturity, owning is not adulthood. They are two financing structures for the same human need, which is a door that locks. The people who get destroyed here are not renters and they are not owners. They are people who bought a house they could barely afford in a city they were going to leave because someone told them they were throwing money away. That one sentence has cost Americans more than almost any other sentence in personal finance. Quick reminder, I am not a financial advisor and this is not financial advice. Run your own numbers, ideally tonight, with your actual property tax bill filled in, and if this reframed anything for you, that school community link is below. So here is the question I would leave you with. It is not, can I afford the payment, because your bank will happily answer that one wrong for you. The question is this. If you knew for certain that this house would be worth exactly what you paid for it in 10 years, not a single dollar more, would you still want to live in it? If the answer is yes, buy the house. You are buying a life, and the math will probably follow. If the answer is no, you are never buying a home. You are buying a bet, and there are much cheaper places to gamble.